Good morning, guys. Look, I apologize for the delay. We had some technical issues on our side. So yes, apologies for that. So look, welcome. It's a pleasure to see some regular names here. Yeah, and it's also great to see we are growing as a trading community. I just want to ensure you can see my screen. We can all see the welcome slides and hear me loud and clear. That would be fantastic if you could just let me know in the chat box, just Y or N. Y for yes and N for no. Just really, yeah, thanks guys. Excellent. Thank you, Shona. Brilliant. Okay. So first and foremost, on behalf of me and the FP Markets team, I want to extend my thanks for all those who have joined today. I really hope we're able to walk away from here more informed, educated traders. This presentation is particularly important. It is actually crucial to have a trading plan and for success in trading and investing. Yet so often it is overlooked by many of us and could very well help explain why so many fail in this business and few do very well. So now it'd be great to know how many of us here work with a trading plan. So how many of us here actually spent the time to define and write out a trading plan? If you want to let me know in the chat box, look, go ahead. That'll be fantastic. So I can get an idea of what we're working with today. If not, that's fine as well. Just follow along and hopefully you'll take something from this presentation. Also, as an aside, any newer traders here today, I'd encourage you to check out the previous webinars that cover a number of topics. Recordings of previous presentations and today's presentation is available on the FP Markets YouTube channel and also on the FP Markets website under the Education tab through Resources. Good day. Wow, I cannot pronounce your name. I'll just call you Ray. I think that's the polite way of saying it. Thanks, Maureen, for confirming you can see the screen. Look, so yes, let's just run through the disclaimer as usual, guys. Look, the information contained in this material is intended for general advice only. It does not take into account your investment objectives, financial situation, or particular needs. Look, guys, as usual, I will not read through the entire disclaimer. The main point is this is an educational presentation and not direct investment advice. Again, apologies for any of the familiar names here. You will be aware of who I am, and this is solely for any newer traders present. So we all know who's behind the mic. So just really quickly, I'm the technical analyst for FP Markets. I've been involved in the financial markets for more than 12 years now. I'm also a CMT, so I completed CMT levels 1, 2, and 3. And I also, as an extension to completing CMT level 2, I received the CFTe qualification in 2020. And look, I've recently signed up, enrolled for the CFA as in level 1. So that's particularly interesting and intense. Look, finally, for me personally, I am a technician and I specialize in price action. Price action is key for me. I also specialize in Fibonacci applications. The relative strength index is a particular favorite of mine, and also chart psychology. Now, chart psychology, as I've said in every webinar, is quite complex. And it took me many years to actually understand how I can view charts through a psychological standpoint of where buyers and sellers may be trading. So this is something we will go into in future webinars. So as you can see on the slide, the main motivation of today's presentation is defining what a trading plan is and what it is not. And also to understand the components that form a trading plan. At the end, we'll also look at answering any questions you may have. Look, if there's a question I'm unsure of or of how to answer, or a question that requires a detailed response, I think it would be better if I email the attendee directly. This will avoid confusion and at the same time provide me some time to conduct research if necessary. So what is a trading plan? I think at first it's easier to highlight what a trading plan is not. So a trading plan is not a few notes scribbled on the back of an envelope. A trading plan is not simply your trading method. This is often confused. And a trading plan does not guarantee success, but it certainly helps tip the scales in your favor. So a trading plan, put in the simplest of terms, is a comprehensive gathering of rules and guidelines that governs each part of your trading routine. Many newer traders, or amateur traders, I guess you could say, do not have any sort of plan to trade by, and they enter the markets with, little regard for their risk and little regard for their profit objectives. Suffice to say, comprehensive risk and money management strategies lie at the heart of all good trading plans. Just bear with me, guys. Just bear with me. Just bear with me. Excuse me, guys. Okay, back to it. Sorry about that. Okay. Right, so traders with a plan have the ability to also monitor their performance. They can evaluate their progress continually, day by day, in a way that is disciplined. Sorry, in a way that is objective. Excuse me. This enables them to trade less emotionally and with minimal stress. The trader without a plan is, as I'm sure you can imagine, is not able to do this, and their trading tends to rely upon gut feeling, hunches, and tips from forums and things like that. Trading for them is it's an emotional roller coaster of stress that will inevitably lead to financial. It will inevitably lead to financial loss. So who needs a trading plan? Look, if you have been consistently profitable over a sufficient length of time and have ingrained your trading plan to memory, you will not really need to be checking your trading plan, your written trading plan. But I'm sure most of us here do require a trading plan. Look, guys, without it, you are trading blind. You are driving blind, with no lights down a dark street, if you will. The point is, we all need a trading plan. So some people have described a trading plan as a roadmap. So a map designed to get you from point A to point B as safely as possible. Point B is clearly trading consistency and trading profits. Point A is the beginning of our journey, our account deposit, and a clear trade log. Think about it like this. Oh, where's my cursor? There it is. Think about it like this. So would you drive across your country without a map or GPS switched on? For most of us, we would not even think about this. We would not even think about attempting this. It would lead us to unknown. It would lead us to unknown destinations, and may even lead us to breaking down through lack of fuel. So why on earth would we think we can safely navigate the markets without a roadmap? Running out of fuel in our driving example is akin to consistent losses. Our car or trading account has not broken down. It's just temporarily stalled, if you will. The main point is, like we use our GPS when we drive, we must use a trading plan to govern direction in our trading and investing. This is a super, super, super important slide. So new traders must understand that there is a difference between the trading plan and trading strategy. So A trading plan, as I already alluded to, is a complete arrangement of rules governing your trading process. It should be reasonably detailed, and it is placed within your overall trading plan. And it is within your overall trading plan lies the trading strategy or trading strategies, which is your entry and exit guidelines for the market. So to be clear, a trading plan incorporates all components of your trading life, while the trading strategy or system forms one element of the overall trading plan. So if we think about it like this, so think of a trading plan as a 10-page notepad, and 2 pages are dedicated to your trading system, while other pages focus on elements such as the risk and money management goals and things like this. Okay, by this point, I hope we're all on the same page, namely that we should all be working with a trading plan. So what will a trading plan do for us? So a trading plan will make the act of trading much simpler, and it will make it much simpler than if you were to be trading without a trading plan. It will also limit your opportunity, your opportunity to make bad trades. And it will prevent many psychological issues from emerging. Most importantly, if your trading is going badly, you will know it is down to only one of 2 possibilities. Either something in the plan is not working, or you're not adhering to the plan. If the plan is a good one and it is back tested and forward tested, either with a demo account or a small live account, then the fault is likely to be found with you not respecting the plan. But what if you're losing money whilst without a trading plan? It would be, guys, it would be virtually impossible to distinguish what you are doing right from what you are doing wrong. So performance evaluation. So a trading plan, as I already alluded to, can act as your personal GPS device and to locate your position. And if you have made a wrong turn, it provides the means to identify where you went wrong and how to get back on track. With a trading plan, you are able to evaluate your results, and more importantly, you also evaluate your discipline in a manner that is objective and comprehensive. This is extremely difficult to do without a trading plan. And finally, a trading plan should aid decision making. It should take away much of the decision making. Emotional issues will become very, very powerful when real money is on the line and potentially force you into making irrational decisions. So with the correct trading plan, your every action should be, it should be spelled out so that in the moment of trading, you do not have to you do not really have to effectively make any decisions. You just follow the trading plan and follow its guidelines. So with everything said so far, we would rather be this person here rather than this person here, right? I can all assume we would agree with this. Look, before we get into the nuts and bolts of some of the components in a trading plan, a few points I really want to highlight is just bear with me, is with a plan, trading is much more simple. Okay, A trading plan, with a trading plan, life is much more, your trading life will be much more simple. With a trading plan, you can monitor. Yes, guys, I'm sorry, you're going to have to excuse my handwriting. I know it's not the monitor. You can monitor your progress. This would of course be helped by a trading journal. Now, which for me should be included within the trading plan. A trading journal has proved so beneficial to me in my earlier days. And just to be clear, I did not always focus on I did not always believe that I needed a trading journal in my earlier days, but I know how key it is in trading now. A plan also helps prevent many psychological issues that rear its ugly head. It will also reduce the number of bad trades. So assuming the plan is adhered to, it can also prevent irrational trading decisions, right? Because you're just simply following your plan. And when you created your trading plan, you were not acting irrational. You were in a calm state. You were rational. You were in an objective state of mind. So by following your trading plan, it will help prevent irrational trading decisions. A plan also can enables you to control the only thing you can control, which is yourself. Look, professional traders are, they are highly disciplined. I cannot emphasize this enough. A plan will instill a large measure of discipline into your trading. Gamblers tend to lack both discipline and a plan. When I'm talking about gamblers, I'm talking about the amateur gamblers. So a plan will enable you to trade outside of your comfort zone, but in a structured manner. So how many times have you let a trading loss run, or cut a trading profit short because it was the comfortable thing to do? So a plan executed with discipline will help you avoid this from happening. It will allow you to operate outside of your comfort zone, but in a structured, as I said, in a structured manner. A plan, as I've also said, is your roadmap. It's your roadmap which will enable you to get from wherever you are now, to wherever you want to go, i.e., which is obviously for most of us is trading consistency. Let me just remove these drawings. Bear with me. Okay, so here's where we get into the finally get into the nuts and bolts. To kick things off, there's a few questions you must ask yourself. You have to question yourself, which I believe should be written in your trading plan. Look, guys, excuse the, I'm not sure if you guys can see this, but we do have some advertisers in the chat box. So if you could just ignore them, that would be fantastic. It's just a little bit distracting for me because the box keeps coming down on my screen and then I think someone's asking a question when it's not. So just please ignore that if you can. And I'll try to get to any genuine questions at the end of the presentation. So look, question yourself. Why do you want to be a trader? And what are your primary goals in trading? So look, are you certain that trading is the right business for you? If you believe that the markets exist to provide you with a mobile ATM machine after taking a weekend course with Bob the Guru, then think again. It does not work like that. No matter how many YouTube clips, YouTube advertisements you've seen. Look, another question, do you have plans to become a full-time trader, a part-time trader? How will this improve your quality of life? These are questions we must all honestly confront and answer. Also, in terms of goals, you will need to consider your annual goals, your monthly goals, weekly, and sometimes even daily trading goals. Now, for me personally, I rarely set daily or weekly goals. I'm just not comfortable operating that way. I prefer to give myself some breathing space and actually set quarterly goals alongside my yearly goals. Now, these goals, just to be clear, these goals may not be only financial. They may be to improve your discipline in adhering to your trading method. It could also be to read more books, for example. Okay, so what trading style would you prefer? So you have to think about this before within your trading plan. Are you a discretionary trader? Are you a non-discretionary trader? So a non-discretionary trader are those that trade with algorithms. So they're system traders. Do you propose to trade in the long term, the medium term? So are you looking medium term, like a few days to a few weeks, holding your trades? Short term, are you a day trader? Are you a scalper? So the choice of, position trader, swing trader, day trader will largely be determined based on the amount of time that you're able to devote to trading. Day traders, do not get this wrong. Day traders have to be, for the most part, they are glued to their screens for the majority of the day. Now, if that does not appeal to you, I would recommend maybe even adopting a swing trading strategy, which will allow you some freedom from the screen. So you can check the trades maybe twice a day, once in the morning, once in the evening, and it also allows you to keep your full-time job. This is a key psychological benefit of trading, swing trading or position trading. Even that's long-term trading. It allows you to keep your full-time job, so you're not attempting to force the markets to give you a weekly salary. It just does not work like that. So look, the key point is it's important to define your trading style. So another key note in your trading plan is which instruments to trade. For me personally, I've only ever traded currencies, really. I did dabble in the options market in my earlier days, but have largely stuck with currencies. So most professional traders I know tend to restrict their focus to a limited number of markets or instruments. The other side of the field, novice traders tend to trade, equity indexes one day, exotic currency pairs the next day, and then maybe take a punt on cryptocurrencies the next day. Look, I'm certainly not here to say that you're wrong to do this, as long as it's in your trading plan. But the general consensus that I have found is the more experienced traders work with only a few markets. They get to know these markets. They understand how they operate. So for instance, a trader might only focus on currencies and commodities. Another decision, of course, is which time frame will you trade? This should have really been in the I should have really mentioned this at the previous slide, but nevertheless, look, this will obviously be decided through which trading style you adopt. So if you trade short term, you will likely be working excuse me, be working with lower time frames, such as the 5-minute charts or the 5-minute charts, or maybe even the 15-minute charts. If you're a scalper, you may even focus on the 2-minute charts. So for swing traders, they tend to focus on the H1, H4, and sometimes mainly H4 and daily time frames for a swing trader. So above these time frames, we are then looking at position trading. And this is more of an investment style approach. So these trades can really stretch from weeks to months to sometimes even years. You may also choose. That's a very good saying, Nick. Thank you for bringing that up. He who chases many rabbits ends up with none. I'll have to remember that. That's really good. So yes, that would perfectly explain what I went through just a minute ago. He who chases many rabbits ends up with none. If you remember that, you'll be set, I believe. Look, just finally on to regarding time frames. You may also choose to work with a multi-time frame approach, and this is what I actually prefer to do. Look, tools of the trade. Now, so here within your trading plan, you have to list the brokerage you trade with, and importantly, all of their contact details. There is nothing worse than having an issue and and not having the relevant contact details, immediately available to you. And with this, of course, you will need to note which platform you are working with. For me, it's imperative that you are familiar with with the broker and the trading platform before going live, i.e., investing live capital. This includes being familiar with of course, with the broker's order types and their business model. And this will lead you on to their data feed. So with FP Markets, data, I believe, is free of charge and provided largely through MT4 and MT5 in various markets. Okay, daily routine. Right, just bear with me. It's Greek philosophy. Thanks for that, Nick. That was excellent. I really like that. It's best so we have a comment here from Promise. It's best to stick with one purpose and plan. Totally agree. So we have a really interesting comment here from Maggie. Maggie, you didn't email me. I was looking for your email regarding the Mark Douglas's book. So look, a comment here from Maggie. According to Mark Douglas's book, am I correct in thinking that trading is ultimately gambling with a plan? That's a very, very good question. And, that will depend on who you ask. For me, God, I know there are a lot of comparisons between gambling and trading. I believe traders we are professional traders. They are disciplined. They have a plan. They work to a plan. They're not going to a casino, right? And they're just red, black, or whatever they do in the casinos. They're not going there just for fun. This is not a hobby. Trading is not a hobby. It's a serious business. So for me, I think, to be honest, gambling, you're almost gambling with a plan, and it's almost structured gambling, if you will. But I hate that term, gambling, with trading, to be honest, because I do not feel like I'm gambling when I'm trading. Although, I'm probably going to get a load of comments regarding that. Yes, Shona, trading has clear risk mitigation strategies. Gambling is either win or loss. That's fantastic. I couldn't have put it better myself. Trading has clear risk mitigation strategies, which should be in your trading plan. So yes, thank you for that, Shona. We have a question here. What is the best time frame to trade? Promise, that's not really a question that I can answer, because you can only answer that. Regarding time frames, that's, as I said, just literally 5 minutes ago, the best time frame to trade will ultimately depend on you. So if you're available all day and you're retired and you have, say, $10,000 to trade with, you could quite easily become a day trader, and that would allow you to trade the 5 to 15 minute time frames. Now, I know some traders do say that you cannot make money on the short term. That's absolutely incorrect. I know traders. I've done it myself. I know traders that do this. So it can be done, but it takes a very a disciplined individual to do that. So look, Promise, in terms of your question, I think you're the only one that can really answer that. It depends on your time available. Okay, so daily routine. Daily routine, this should be clearly noted in your trading plan. Do we need to check yesterday's trades, assuming you're an intraday trader? Do we need to check yesterday's trade, assuming you're a swing trader, I guess you could say? Do we need to assess the current position of active trades? Remember, if your trading plan states not to hold positions overnight, this would mean you're a day trader or a scalper. Then do not break this rule. Close trades, assuming we're trading FX, of course, before 5 p.m. Eastern Standard Time. Will we assess current market conditions? So for me, I love the index equity futures. I also look at the equity markets, the cash equity markets, if they're open. You can usually use the major equity markets to gauge risk sentiment. So I'm a big fan of that. You can also check bond markets. So where are the US Treasury yields? They're currently very high at the moment. where are they? So if we are higher across the treasury yield curve, we know traders are selling bonds, which is generally considered a risk on trading environment. So you can also check the US dollar index, like for currencies. You can also check you must also check economic indicators. I must make this clear. You should or must also check economic indicators that are on the calendar for your trading day, your trading week. And are there any major news stories that must be taken into account? Look, the geopolitical tensions between Ukraine and Russia are just key at the moment. And this really, as I'm sure you're all aware, that this is governing risk sentiment. Yeah, so these are things you need to be aware of and you need to really have noted in your trading plan. Yes, checking currency strength as well is very good. Yes, totally agree. So you can do this for free, like on many platforms. You can see, is the Aussie dollar outperforming against other currencies? Is the New Zealand dollar outperforming? Is the dollar outperforming? And things like that. Totally agree. So risk and money management methods must be included within the overall trading plan. Unfortunately, this is often overlooked because we all believe that all we need is markets analysis to become a successful trader. Market analysis only forms a small component of your trading plan. So failure to apply risk and money management principles will almost certainly lead to financial ruin in trading. I know this may sound harsh, but it is, it's almost a certainty. And there's not many certainties in trading. So risk management focuses on the steps necessary to minimize losses by assessing market conditions, risk reward, probability, and of course the use of stop loss orders. Money management focuses more on the steps necessary to maximize profits and by adjusting position size. So look, we all have a different attitude to risk, and therefore we will all have a slightly, we will all have slightly different trading plans. Okay, so points you will want to include within your risk management plan. Of course, risk tolerance being the first. Now, risk tolerance, this is the risk tolerance on each trade. So this will be different for all of us, despite the rule of thumb saying that you should only risk no more than 2%. I don't fully adhere to this, to be honest, but look, some of us assume we have a $10,000 account. Some of us are just not comfortable losing $100 on each trade. We're just not comfortable. So we might have to go down to $50, so 0.5% risk. Okay. Some of us are certainly not, we're not comfortable losing $200, so 2% on a trade. This all depends on what your comfort level is. So this is key. This really needs to be defined in your trading plan. Next up, we have hardware risk. Now, this may seem an odd one, but hear me out. So if your computer crashes and you have active trades open, what would you do other than panic? You must have this scenario detailed in the event of its occurrence. So have the contact details of your broker written down at your trading desk. Have a backup laptop even. Many of us have, backup, 1 or 2 laptops nowadays. So have a backup laptop ready to go in the event something does go wrong. Many traders I know even have backup generators. This surprised me when I was, my mentor actually showed me his a backup generator. This really surprised me when I was in my earlier days. They are relatively small, and I think they are battery powered, but will help get the job done if the electric is cut. Some traders, this is my mentor again, he has 2 internet connections, but he trades an incredibly large account. So as you can imagine, this is this is reasonably large amounts of money on the line. So to pay $20, $30 or whatever it is in your country for another internet connection is nothing in the grand scheme of things. So yeah, Some traders will have 2 internet connections ready to go. Next on the menu, of course, is a reward to risk. I know many of us say risk reward, but I'm not sure why we say that, because when you look at the ratios, it is 2 to 1, 3 to 1, and things like that. So it's normally reward to risk. Okay, so we must assess the reward to risk in our trade. The rule of thumb many appear to follow is 2 to 1. And assuming your win percentage is at least 40%, so this is your winning trades over your losing trades, and assume that is 40%, then you will earn money over the long term. It is important to understand that there is little point in having a strategy that wins 90% of the time, but only delivers a small value when it wins. So look, imagine we win $10 on every trade. So 9 out of 10 trades, we win $10. That's $90. But on the 10th trade, we lose $200. You know, you're not going to end up in a good shape. You know, the key point here is you must address reward to risk in your trading plan. So how do we generate this reward to risk? How do we apply this? How do we understand it? So quite simply, we can determine our reward to risk through backtesting, which is a must for all trading approaches. How many of us here would actually hand on heart, honestly, can say that they've conducted a thorough backtest of their strategy? So yes, I would be interested to know that in the chat box, if you guys were open to share that. How many of us here have actually back tested, and how many sample sizes do you have? So we have a question from Maggie. Do you have a lot size calculation formula? Position sizing, I assume you're talking about. So off the top of my head, I'm going to try and calculate this for an account denominated in the same currency as the quote currency. It's quite simply trade risk, so how much you want to risk, so $200 divided by the stop loss distance, and that's multiplied by a factor of 10,000. That would give you your lot size, your unit size. For an account currency denominated in the same currency as the base currency, wow, you know what? I've completely forgot these calculations. I've got so many calculations in my head at the moment. So look, Maggie, if you really want to know how to conduct this, you can use, yes, thank you, Pete. You can use the Baby Pips position size calculator, or if you want to understand how the formulas behind it, I can email them to you when my brain's a bit more connected. So look, yeah, no worries, Maggie. So I want to ask if someone will succeed without the help of an indicator or any other software. This is a question from Promise. So just to reiterate that, I want to repeat that, excuse me. I want to ask if someone will succeed without the help of an indicator or any other software. So you need software to trade, or obviously you need software to trade, the MT4 or things like that, but you definitely do not need indicators to become successful. I can guarantee you that. There are many traders that focus on price action techniques, myself included. I'm a big fan of price action techniques. Yeah, so the answer to that question is no, you do not. But many successful traders do believe in indicators, and it works for them. So it's all really what works for you. And then that can be found out through backtesting again. Okay, moving on. So protective stop loss orders. Look, guys, I'm pretty sure we all know what these are. These protect your accounts in the event of an unfavorable move. While this will be detailed in the trading strategy, it is important to note that this should be placed in your risk management folder as well. I would also strongly recommend all traders employ a stop in their trading. It is there to help limit potentially devastating loss to your account. You know, as account ruin, it can be called. So our equity is brought down to a level that we would find it very, very difficult to recover from. Finally, when to stop trading. Now, this is good risk management, in my opinion, and will vary between traders. Do you get do you get frustrated after 2 consecutive losses in a day? This could be your threshold to stop trading and shut down the computer. Knowing when to stop trading is good. It is both good discipline and good risk management. You know, additionally, it helps prevent chasing losses on losing days and helps prevent greed from rearing its ugly head on winning days. So every single day, every single trading day should end in one of 3 ways. One, on a winning day, where you have a very simple rule for stopping trading once you have reached your target. 2, on a losing day, you have a daily stop and cease trading as soon as it's hit. 3, some days, you know, look, guys, being flat is a position as well. Some days there are not any trading positions to be had. That's just the way the market works. So you do not trade at all. Okay, on to money management. Look, first and foremost, money management, trading capital. Your trading capital must be money you can afford to lose, and it should be set aside from everyday expenses. Look, it should not make any difference to your standard of living if your account was wiped out. Okay, this should be clearly defined in your trading plan to the amount to your account equity that you're willing to commit. Okay, so how will you lock in profits? So lock profits. I guess this could also fall under the umbrella of trade management, but for me, locking in profits is incredibly important. You know, look, it always gets me when I read traders saying that winners will take care of themselves. Unless you're insane and you just leave your computer for a couple of months and the trade just keeps going higher, just keeps rallying, then yeah, fair enough. But that is just not the case. We need to manage these positions and combat the emotional challenges that comes with this, right? That comes with price moving in our favor. Many will utilize a trading stop in this case, in this scenario, and how this is done would ultimately be trader subjective. A trading stop could be as simple as following a trend line. It could be as simple as using a simple moving average and exiting the position once price closes below that simple moving average. It could even be a crossover moving average. You know, there's a number of different methods you can. It could also be even based on the ATR. You can have the ATR set to 2, set to 3, and that will trail as price moves higher. So many do employ a trading stop. So position size. How will you determine position size? The size of your position should never exceed the parameters specified in your risk management rules. This should be obvious, guys. So look, the topic of money management can appear quite dull to many traders, as you know, as I've noticed over the years, that many prefer to concentrate efforts on method development. So look, the development of your trading strategy, you know, albeit crucial, we must also adopt a well-rounded skill set if we want to be traders. Taking on board risk and money management principles enables us to be successful and, more importantly, remain successful long term. So what is money management? Well, as its name implies, money management is simply the management of your money, your capital, or your equity in your account. And for the sake of clarity here, money management applies to every single trader. Whether you trade an account of $1,000 or $10 million, money management principles should also be applied to both short-term and long-term trading. So I'm not going to go into detail in regards to this, but we have the martingale approach in terms for money management strategies. We also have something called fixed fractional, which I believe was developed by Ralph Vince. So this is something I use. So if I had to sum up fixed fractional in a few sentences, it would be this. So risk is kept consistent at a consistent percentage. So while the account grows exponentially due to inherent compounding and what it does is it contracts during drawdown. and this helps preserve the remaining capital. So the fixed fractional method states that for every trade, no more than a predetermined percent of the account balance will be risked. Look, so as a quick example of this, let's say we have a $20,000 account, and I trade according to the fixed fractional method of 1%. That is 20,000 multiplied by 0.01 or $200 on any given trade. And from this, we need to work out our position sizing. This, as I said, increases contract size when winning and reduces risk when losing. So this is the hallmark of good position sizing. We also have the fixed ratio method. This is another approach. It's an interesting approach, but not one that I've really looked into. It was developed by a gentleman called Ryan Jones, and it was primarily for the futures and options market, I believe. He's also written a book called The Trading Game, I think it's called. I'm not too familiar, as I said, with this method, but it's certainly worth mentioning for anyone interested. Okay, trading strategy. So finally, we're on to trading strategy. Look, this is where we will detail our trading setup, our rules for entering and exiting the markets. So a trading strategy is a plan that employs market analysis to highlight price levels or market conditions, through fundamental analysis and technical analysis to predict price movements. Most strategies focus on specific technical indicators. So so the main trading strategies that I'm aware of is trend following, momentum, range trading, breakout trading, and sentiment. So trend following approach, is pretty much self-explanatory. You attempt to capture trends, you attempt to ride trends, and you can use indicators such as the simple moving averages or the exponential moving averages. The ADX is a good indicator for trend following. And what you're doing is you're attempting to catch the large part of the trend. So if you get in at this point here and the trend begins down here, let me just draw this on, it would be a lot easier. Just bear with me. So if the trend, just imagine this is the trend. Okay, and if you enter on the dip, say here, and you exit, say, around this point here, you've attempted to capture a large part of the trend. Yes, you could have entered here and again exited at this point here. But what you're doing is you're looking to capture the largest part of the trend. Look, guys, you're never going to get in at the top and get out at the top and get in at the bottom. Look, if you have, well done. That was very, very lucky. But to do that consistently is very, very unlikely. So you're looking to take a major, a hefty portion of the trend, to ride a hefty portion of the trend. We then have momentum. So momentum strategy is an approach that seeks to exploit price movement within a trend that is picking up traction. So momentum trading is you can think about it as a method of buying and selling according to the strength of price trends. It is based on the idea that if there is enough force behind the price move, it will continue to move in the same direction. Range trading. Quite simply, guys, look, I'm pretty sure most of us are aware of this, but range trading is where you're seeing price range between two limits. So this is a consolidation, a basic rectangle, and you will also see these form within trends. So this is the uptrend here, and you will also see ranges form within trends. So you will have sellers coming in at this point here, and you will also have buyers coming in at this point here. But if this is formed within the overall trend, a breakout to the upside is highly likely. Next up, we have breakout trading. Look, I've just really touched on breakout trading there. Breakout trading is a strategy that's of entering a given trend as early as possible. It can it can be defined in a number of ways. But look, breakout trading, we had a breakout to the upside at this point here. Okay, we had a breakout to the upside. We broke out of a range. So this is breakout trading. Some traders enter on the close of the candle outside of the range. Some traders prefer to wait for price to retest the range retest the breached range edge before taking a trade. Okay. Yes. So this is what I would consider as a definition for breakout trading. And finally, we have sentiment trading. I'm not going to go too much into detail with this. Look, sentiment analysis is not something I use, really, to be honest. I suppose I do if you look at the VIX and things. The VIX is the volatility index provided by the Chicago Board of Options Exchange. I think, I can't remember the name now. The SIBO. I also look at, you can also look at the COT report, the Commitment of Traders report, which is released every Friday by the Commodity Futures Trading Commission, CFTC. This data is based on positions held as of Tuesday, which means the data is not real time, of course, but it is still useful. You can also use futures interest, open interest. The Forex market, as you know, is over the counter with independent brokers and traders all over the world, creating a marketplace. So while some brokers do publish the volume produced by their clients' orders, it does not compare to the volume or open interest data available from a centralized exchange. Hence why we sometimes look at futures open interest. And finally, you can also, as I just said, you can look at position summaries from the broker. This provides transparency to the over-the-counter Forex market. Many Forex brokers do publish the percentage of traders or trades that are currently long or short in a particular currency pair. Do bear in mind though, guys, this is data only gathered from the clients of that broker, and therefore produces not a full picture of the market. Okay, let me just clear these drawings. Okay, right. Let me just check the questions. Okay, so look, guys, please fire away with any questions you have, and I'll try and get around to them now. So from Maggie, I usually wait for confirmation for the breakout before entering, but a lot of times it goes against me. You'd have to send me an example of your trade, Maggie, for me to really understand. Are you trading, as I said, when you say you're looking for confirmation of so are you just trading basic rectangles? You have to be careful with these because ranges, look, the professional traders know that we are going to be looking to buy the breakout, right? It's common to see whipsaws. So what they're looking for is, these professional traders are looking for these breakouts here. And what they know is there are going to be buyers here. There are going to be buyers here from not only breakout buyers' orders, but there's also going to be buy stops from those fading this upper limit. So with all this buying pressure, with all this liquidity coming into the market at this point here, there are going to be sellers looking to come into this and buy into that. So you have to be prepared for that. And this is where experience comes in. So for instance, what I would be looking here, I probably wouldn't be looking to trade the breakout of such an obvious range. I would be looking at an area over here somewhere, almost not hidden, but almost, not as obvious. Sometimes you can get some really nice decision points at these points here, and it's just obvious what's going to happen. So price, obvious what's going to happen. When I say that, I mean, it's a high probability that price will break out, test this area, and you'll get larger sellers come in. And what happens is these buy stop orders fill these limit orders. So they fill these offers at this point here, and then price moves lower. Okay, so this is something you have to be aware of, and this is known as a bull trap, and to the downside would be known as a bear trap. And it makes sense, right? A bear trap, a bull trap, and a bear trap. So it's trapping you. What it's doing is forming a trap for your breakout. And you know, guys, this can even happen on a retest. So price could come out of the consolidation, retest the area, and then we're all in, right? We're all thinking that it's going to continue higher. Price rebounds off of this area and then tests this this decision point and then slams against you. It's another form of a bear trap. Okay, a question from Shona: does sentiment trading use fundamental analysis instead of a preference to technical analysis? As I said, Shona, I don't really use sentiment analysis that much. I do look at the VIX. I guess you could say it does use fundamental analysis, to be honest, but not really. I tend to blend it with technical analysis, to be quite honest with you. Okay, so no more questions. Thank you for all the thank yous. That's very kind of you. Look, Maggie, do send me an example. You've said that I might send you an example. Don't mind. Send me an example and I'll check it out for you, and then I'll give you my honest opinion of how you can potentially handle breakout trades. Do you have a recommended template or a trading plan? Do we use a Word doc? I knew this was going to be a question. I should have prepared for this. Look, to be honest, my trading plan is very, very simple. It's a Word document. There are companies out there that do provide trading plans, and I think they might charge you for it. But look, you do not need that. All you need is to have some structure of how you structure your trading life. It doesn't have to be anything fancy. It really doesn't. So yes, as you said, do we use a Word doc? For me, I've used a Word doc. You might be more comfortable with a spreadsheet or something like that, but for me, it's a Word document. Okay, all good. Okay, that's excellent, Shona. Thank you. Yeah, thank you very much, guys. Right, that's it, guys. So look, just really quickly, look, as always, look, any specific topics you would like the team here to talk about, please be sure to send in your suggestions to the emails shown. Market Analyst, sorry, I've just gone through it there. Market Analyst at fpmarkets.com, and support, I've just gone through it again, support at fpmarkets.com. Okay, so these are the emails you contact. Look, I would recommend use this email here, Market Analyst at fpmarkets.com, because that goes direct to our research team, and that will allow us to reply quicker. If you send it to the support team, all they'll do is they'll probably forward it to the research team. So if it's regarding the content. So look, the final webinar of the month, please do not miss this, guys. It's about Fibonacci. Why is Fibonacci? What is Fibonacci and why is it important? I will really go into detail here regarding Fibonacci concepts. I see a lot of traders getting this wrong and applying this incorrectly, applying the terms incorrectly. And that's on the 24th of March at the same time, 9 a.m. GMT. Also, as I say in every single webinar, please do make sure you subscribe to the Telegram channel to get instant updates. Yes, so instant updates. The sign up tab can be found at the lower tab of the or you can use the chat room. It's there, the link, but it can be found on the main website at the lower left side. So look, guys, have a great day. Thank you very much for all the kind thank yous and things like that. And I'm very happy you've taken something from it. Again, any questions, guys? We're here to help. Use these emails, and we'll get back to you as soon as we possibly can. Okay, guys, thank you very much, and I'll catch you all next week. See you later. Bye-bye.